What if I told you that you can get what would normally cost $5,000, let's say? What if I told you that if you had this certain credit card, you could actually get that item for free? Would you be interested? Watch this. What we want to do is rearrange your thinking when it comes to velocity banking. Let me show you how velocity banking works. And then we're going to show you how you can get that $5,000 purchase, let's say, for free. And even if there's a $5,000 purchase and you can't exactly get it for free, if you use your line of credit or your credit card in this way, you can get it for very, very cheap. And I'm going to show you that right now, okay? Listen, this is the Velocity channel where this is your bridge to financial freedom. Today we have a very special episode, and we're going to go from beginning to end so you can actually implement these steps today in your finances. Before we get into that, like, share, and subscribe so that people from all around the globe can know the power of velocity banking and start getting their things for free or much, much less than they would have paid for it. All right. So let's go ahead and say you wanted to buy, right? So we're going to go ahead and do the purchase thing and buy something. Maybe it's an education. Maybe it's an item that you really wanted for Christmas or Thanksgiving, right? And it's $5,000. Now, you got in the mail a 0%, let's just say, offer. Nowadays, we have 0% for 12 months. We got 0% for 18 months. We've got 0% for even 24 months. So let's just say we get it for 12 months, all right? A $20,000, let's say credit card, right? At 0% for the 12 months, okay? Now remember where this money came from. This is an unsecured credit card, meaning you didn't have to necessarily work on a job for this credit card. They saw your credit score, right? Researched you, looked up your name, right? Your birthday, social security number, and they said, why aren't we giving this person more money? And they said, look, watch this, $20,000 at 0% and 12 months. Listen, you qualify for it. Congratulations, right? And you say, man, thank you for this seemingly free money. But you're not going to use this money for just anything. You're going to use it to purchase something, whatever that something is. Let's just say you wanted to invest in yourself, right? By buying an education or maybe a software, whatever, you fill in the blank, but it costs $5,000. Now, if you were to purchase this with the $5,000, first of all, it's way below the 30% credit utilization, so you're safe there. Next, I'm going to show you how that you actually got this for free. All right? Let's hop into it right now. We are using this line of credit, and we're saying, okay, I want to transfer this $5,000 that is within this line of credit to this purchase. So now I have this purchase, whatever it is, and now I have $15,000 left on my available credit. The only problem with that is now you have a balance of $5,000, okay? That's your balance. Well, let's say you have an income of $5,000, right? So 5K is coming in on the income. You do have an outgo of $3,000, right? So we go ahead and subtract that. You are left with 2K, right? Let's go ahead and draw a boundary around that. That's your income. Now you're using your line of credit as your new checking account. And I need some participation on here. I need you to say in the comments what you think it is. If I'm using my line of credit as my new checking account, when am I going to pay this card off? Okay, so let's go ahead and do that. Remember the formula? It's line balance divided by what? The cash flow, okay? In this case, the line balance is 5K. So we're going to go ahead and put that 5K right here. Then we have the cash flow of what? Okay, what's 5K minus 3K? It's 2K, right? Let's go ahead and put the 2K there since that is our cash flow. All right, let's go ahead and mark out this. Just focus on this. 5 divided by 2. Now, I'm writing this out so that you see that there's nothing up my sleeve, okay? So we know that that's about 2.5, right? 2.5 months you'll be getting out of that line of credit. So you're going to go back to the $20,000 mark in about 2.5 months. My question to you is, how much in interest did it cost you? Think real long and hard on this, because I'm going to show you something. How much in interest did this purchase, quote unquote, cost you? Well, according to the bank, 0. And because you used your line of credit as your new checking account, how much money are you out of? Meaning, did you write a check for an extra amount on top of the 3K that you're spending monthly? Did this add to your expense, is what I'm saying. Go ahead. And if so, how did it add to your expense? Remember, we're talking about a line of credit here. Okay? You purchased the $5,000. We will recap, right? Now, you got a 5K balance, right? You're paying it off by placing your $5,000 towards the line of credit, which is now at $15,000 available, okay? And then you are spending from your line of credit, your credit card, right, at 0%. So you got to go ahead and pay those $3,000. But the 2K, which is the cash flow, is paying that line of credit down. So how much did this really cost you? And oh, by the way, this is an unsecured credit card. How much did it cost you? How much are you out of pocket? That's what I'm talking about. This is why we must rethink segmenting our income. You know what segmenting means? Segmenting means you've got a whole circle and then you divide it up, right? You're dividing it up. Well, you divide what you want to conquer. But there's somebody else convincing us that dividing up our finances unwisely like this, right, is a good idea, right? Groceries, we have the mortgage, we have the credit card, right? We even got the auto, okay? And they're wanting us to divide it all up instead of looking at the tools that they provide and having that as our payment agent. Do you know what I mean? Let me show you. I know, it's pretty wild, right? And it's just a pretty wild concept, but it works. I mean, don't take my word for it. You do the math yourself, all right? Zero means zero, all right? Let's go ahead and get into the flow of money within velocity banking, show you the differences between traditional banking and velocity banking. One of the main differences is going to be where the money is allocated. Let me show you what I'm talking about. We have the $5,000 or your income going into your checking, right? And how we were brought growing up, right, is to make sure that you pay your bills. And no one told us that credit cards and lines of credit could be an asset. So guess how we saw the credit cards? As a bill only, all right? So you said from the checking, we're gonna pay the credit card, right? We're gonna pay the auto loan, and we're also gonna get our groceries, etc., right? Which left us with more month at the end of the money. But then we got a hold of velocity banking. And velocity banking told us, well, if we get an income, yeah, let's go ahead and continue to put it in the checking. However, we can pay stuff with our credit card, including our loans, including our home loans, including auto loans. Well, let's go ahead and have the credit card be our payment agent. Okay? Payment agent. We're going to make sure that we consolidate our funds into here. Why? Because we are reducing our balance drastically on this credit card. I mean drastically. Okay? And then from the credit card, we are paying the auto, we are paying the groceries, we are paying, etc., etc. Does that make sense? Listen, let's get out of here. We'll see you on the next video. Make sure you take a screenshot of this and let us know what's going on. God bless you and have a great night.